Well, for more on how the energy sector is caught in the crosshairs of U.S.-China trade tensions, I'm joined by Kent Moores, live from Fort Lauderdale, Florida. He's the executive chairman of the Energy Capital Research Group. Thank you for joining us.
Thank you, Rachelle.
So where do the people that you're talking to in the oil and gas industry stand on these escalating tariffs?
Well, the rising tension is not helpful, although most people will tell you it depends on how long these trade disagreements remain. Right now, most of the LNG that's traded internationally, especially what's coming out of the United States, is on longer-term contracts. And until those longer-term contracts are adversely impacted, the market probably can weather this storm.
So how do you see possible tariffs on U.S. liquefied natural gas, or LNG, impacting exporters, especially as they're looking to expand in the Chinese market significantly?
That's a very good question. Most people in the LNG trade in the United States assumed that increased exports to China would constitute the single biggest component in the accelerated trade of LNG out of the U.S. Right now, China accounts for about 15% of all the LNG the United States is exporting. But that figure was expected to rise significantly by the time we got to 2020 and beyond. If we still have this difficulty at this point next year, everybody's going to have to be revising their export contract estimates.
And so what about the challenges for China, especially if it imposes these tariffs on LNG? Because we know China is really trying to replace coal with more clean energy.
Absolutely. The LNG market in China is perceived as one of the biggest expanding markets worldwide, and there's a considerable amount of interest in it. Right now, China imports about 40% of all the natural gas that it needs in a given year, and that's about equally divided between the imports of LNG and the imports of gas via pipeline. But as we've been recognizing lately, the pipeline capacity going into China is actually quickly filling up. There's very little capacity, for example, remaining on the primary pipeline from Turkmenistan into China. They've only got about 5% left. So as we get into the run-up to the winter months, and October is the most important place here because October is when the principal LNG and natural gas contracts for the winter have to be decided. There's going to be a greater reliance on LNG. The bottom line is China will have to resort more to the spot market, and the spot market will be providing marginally greater prices.
So then as we step back, how do you see all this affecting the global supply chain for energy?
I think the global balance, if we wish, is pretty even and pretty tight at the moment. When it comes to LNG, there's one thing you have to remember. Once the liquefied natural gas is on a tanker and it's out there on the open sea, it's a very fungible commodity. That contract may be intended initially to go to China, but it may end up actually in Argentina, or it could end up in Europe. These easily can change. So what I'm going to suggest is that as we move further into this year's energy mix, the longer this trade difference between the United States and China remains, the more we're going to see contract arbitrage, and the more we're going to see LNG switching from intended locations to markets that can generate a greater return.
Now, since we're not sure exactly how long this tariff standoff is going to continue, what is all this uncertainty doing to prices, and how will consumers be affected?
It's too early to tell, actually. In China, however, there is a penchant to pay more in order to guarantee the LNG that's necessary. But to give you some perspective, today in the United States, Henry Hub benchmark natural gas prices closed at $2.96 per 1,000 cubic feet. If we take a look at the height of last winter with China's imports, China was agreeing to pay 380% more in order to get their LNG, in order to weather the winter weather. That's a situation that the United States producers had been banking on, moving their LNG to a market in which they could generate a higher profit. That now may be very much open to doubt with American producers, American exporters, But we see other countries like Australia, Qatar, even Russia, chomping at the bit to get into this Chinese market.
Well, thank you so much. Kent Moores there of Energy Capital Research Group.